PayPal has had a catastrophic fall from grace, up at $300 per share at one point, down 75% to the current sub 80 range, which puts PayPal now at a market cap of 89 billion US dollars and a PE in the high 30s. However, the stock has been flirting with these price levels now for quite some time, and even if we look back previously, it's shown an unwillingness to go lower. So now that they've reported their Q4 earnings results, it's time for us to analyze this business to figure out whether PayPal is a buy, sell, or hold at these levels. So make sure to stick around to the end of the video as we'll answer all your questions and more. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today, we will be breaking down PayPal's fundamental results, coupling that with the trajectory of this business in order to make a projection on this business to see the buying points using our intrinsic value calculator, ultimately ending the video off with an investment rating for this business. So if you do enjoy this type of content, make sure to smash that like button. Also, make sure to subscribe and comment your thoughts in the comments section below so that we can start a discussion there amongst like-minded individuals. So without further ado, let's jump into the analysis. All right, looking at PayPal's Q4 fiscal year 2022 earnings results, what exactly did they provide us with? Well, if we look at this from a full year 2022 summary, we saw active accounts have increased about 2% on a year-over-year basis. Not a lot of growth there, but they did have higher levels of transaction and engagement there, a 13% increase on a year-over-year basis. Same thing with their total payment volumes. Those are up 9 to 11% on a year-over-year basis, which has allowed for revenues to grow. We did see a little bit of a decrease there on their bottom line, but free cash flow is up about 4% on a year-over-year basis. We'll break all this down more in just a second. Now, let's take a look at their progress over the last few years, right? From 2015, active accounts, those were at 181 million. Now today, they're at 435 million across the globe, a 14% CAGR on that front. Total payment volume, $288 billion worth, now up to $1.3 trillion, 24% CAGR. Revenues from 9.2 billion up to 27 billion, a 3x there over that time period, a 16% CAGR. Earnings per share also grew from $1.29 to $4.13, 17% CAGR. And then we saw free cash flow at a 22% CAGR as well. Good results there, which proves the business model. And whenever you see growth like this across a business where their CAGR is in at least the mid-teens to low 20s, you know, that has investors salivating to purchase this stock. So if we take a look at what they've been doing this year to further that growth, you can see here they broadened their portfolio. They're looking to add on to the businesses that they already have that are already generating revenue for them. They also enhanced their digital wallet, revamping their cashback MasterCard and incentivizing more paying clients to continue to use their services, offering higher levels of payment rewards, things like that. And then they're also expanding internationally to grab some more market share. They also recently introduced their buy now, pay later product, which has maintained strong momentum throughout this year. You know, in terms of transaction volume, 160% increase on a year-over-year basis, 200% increase on their transactions, 100% increase on those customers, with a lot more merchants getting on board. And it just goes to show there's a lot of demand behind that buy now, pay later business, and it's going to prove dividends for PayPal stock and fundamentals going into the future. If they can maintain even remotely close to these levels of growth, obviously it will be hard for them to continuously have, you know, such high levels of growth, but definitely a very promising segment for their business. Now, if we look at this from a total payment volume perspective, we can see over the last few quarters, those have been increasing. Their cross-border trade is relatively stable, not too much growth from there. You know, they have been expecting a bit of a slowdown here, especially in Europe. But when you couple that with the increases to their active accounts, transactions, and engagement, you know, you're going to naturally see that increase to their revenues there, you know, up to $7.3 billion for this recent quarter. But as we alluded to earlier, profits have not been increasing at that same level that their revenues have. And so when we take a look at their consolidated statements of income here, you can see, let's look at this from a full year perspective, $27.5 billion worth this year. Again, revenues did increase from that $25.3 billion figure last year, but obviously if you do some simple math here, you can tell right away if profits are down, it's a result of their higher levels of operating expenses here. You can see that across the board. Their expenses are either flat or slightly higher, and ultimately leaves them with $23.6 billion worth of total operating expenses on that $21 billion last year, a $2.5 billion increase with only a $2 billion increase to their revenues, ultimately down about $500 million here on a year-over-year basis in operating income. Now, if you look at this from a quarterly perspective, you can tell it wasn't just a result of a poor quarter this year, at least, you know, beating out last year's results. The reason for the decline was their earlier quarters in the year. You know, quarter 1 and 2 were not as strong. But when we look at this from a balance sheet perspective here, cash and cash equivalents here, along with investments, totaling up $16 billion worth on that balance sheet. Debt is total up at, let's just call it $11 billion worth there. So a healthy cash position on that balance sheet there. Exactly what we look for 2024. And then when we get over here and look at this from a free cash flow perspective, up to $1.4 billion for this quarter alone. Again, we saw lower levels in quarter one and quarter two of this year. Wasn't a great first two quarters, but they've really rebounded and shown some resiliency in the stock in the third and fourth quarters here. Ultimately, 4% growth year over year on a full year basis, up to $5.1 billion in free cash flows. What do they do with those free cash flows? Well, if you look at their capital allocation here for the year of 2022, spent almost $1 billion worth on CapEx and also acquisitions. The rest was all spent on share repurchases down there, which shows you what they're focused on. And I really like how they've been increasing that as the stock has been going lower over the last few years, because it shows management is actually keen to the fact that the stock is probably undervalued at these current levels. Considering we were up at $300 per share not too long ago, now down to just $80 or so. So if we look at this from an operating perspective on a year over year basis, we've seen that increase actually staircasing up to $4.2 billion in the year of 2021. Now in 2022, now that we have the full year results, down for the first time in quite a long time, over a decade there, to $3.8 billion, the first decline on a year over year basis that we've seen even throughout the years of 2019, 2020, etc. But like we mentioned earlier, this wasn't a result of a lack of revenues or sales increasing. It was that their costs had increased by a higher rate. And so when we look at their fiscal year 2023 guidance here, non-GAAP operating margin, they're expecting to actually have an expansion of about 125 basis points there. So an improvement on their costs. They're expecting that this is going to be a result of their cost saving initiatives. Management team is definitely aware that as a result of Forex impacts, along with inflation and things like that, they've had that increase to their costs as a negative impact on the fundamentals of this business. So if they do cut back on those costs, we'll see profitability in the future again. So we have to take all that into consideration here, and we expect that they're actually able to cut back on some of those costs there for next year. They can come in with about $4.5 billion worth in operating income by the end of the year into 2024. If we require a 10% return, they do not currently pay a dividend, and we only expect that this business can grow at just 5% for the next decade on a 35 PE, which is lower than what they're trading at right now. The stock would be worth at least $90 per share at that growth point. Now that's about a $10 increase from where we are currently, meaning if you do believe in this growth scenario with just 5% growth into the future, the stock is probably fairly valued or actually trading subpar at a margin of safety level from a very normal case scenario here. If we expect even higher levels of growth into the future, 12% growth for the next 5 years, that drops down to, let's just call it 7 or 8% there. On a 42 PE, the stock will be worth over $150. Again, half of what it was trading at once before. So it's definitely doable for this stock. Now, in the very worst case scenario here, where we can only grow at a negative rate here for the next 5 years, that finally rebounds on the back of higher levels of cost savings, less competition, etc. At just 5% growth on a 30 PE, the stock will be worth about $60 per share. Again, really not too far off. And then when we look at where we're trading at after hours here, in the very worst case scenario, to own shares down at $60 wouldn't be a very bad scenario. But again, we mentioned that price floor with this stock. Now, if we look at this from a competitor analysis here, market cap trading in and around that high end here amongst their competitors here, in comparison or in line with ADP, which is automatic data processing. When we look at this from a price to earnings perspective here, PayPal trading in that high range there, ADP with a similar market cap trading at a cheaper price to earnings level. Same thing with that Fiserv business there. So you probably have to pay up a little bit to get that PayPal brand name. But when we look at this from an operating perspective, ADP actually has a higher level of profits than PayPal. Same thing with Fiserv. They're actually producing profitability in that same range as PayPal, which you can see here from a charting perspective, which means Fiserv may actually be a little bit undervalued here and something that you might want to take a look at in comparison to PayPal, all the while understanding the growth prospects that PayPal does have. Altogether though, if we look at this since the IPO of this business, we've seen that price floor in and around that $70 to $80 figure, where the stock has really shown a resiliency to push higher off those levels, and we've gotten back to those levels again. So you can expect that the stock probably doesn't want to go much lower than this. So altogether, with everything in mind, with the fundamentals, with the growth prospects, with the competition, if we were to put an investment rating on this business considering the price floor, I'd probably give it about a 7 at this current point in time. I mean, we saw that the business is probably trading at fair value for a 10% return, assuming they can only grow at 5% into the future. And imagine if they can actually cut back on some of those costs as well, they can probably achieve higher levels of profitability into the future. Not to mention the fact that they really have a strong buy now, pay later business that's growing as well. So you're looking at a medium to low risk, medium reward scenario with PayPal. But that's my thoughts on this business. Let me know what your thoughts are in the comment section below. Also, make sure to smash that like button, subscribe, and with all that, I'll catch you on the next one.